So once again, good afternoon to all of you and welcome again to this next talk in this webinar series, which we are organizing. Skill Council is organizing as a part of the Azadi ka Amrit Mahotsav. We have touched, this is the 61st talk which we are doing today. And this Azadi, this event, the Azadi ka Amrit Mahotsav, it was primarily conceived to project the glory of India, the culture of India, how we have progressed ahead and how we will have a India vision too, where we will be more, we will be counted as one of the big economic powers, or we can say, especially in the case of clean energy. I feel this is one area where we will really focus and we will really be an eminent country under this. So this is why these events have been organized. Skill Council has organized talks. We thought we would like to connect with people, connect with audience, and take up issues on various areas, whether it is renewable energy, whether it is sustainability, whether it is SDGs, whether we have so many issues, the waste, water, and you see nowadays the climate, it's so cold. Our Himalayas, they are really, you can say the mountains are really crumbling. Joshimath, that is one of the recent examples. So there are so many issues, so many problems because of the climate change. And we in Skill Council, we have tried to connect with learned people, speakers who can enlighten on all these issues. But mainly our focus has been on technology issues. We have been doing on society, what are the social problems associated, and what are other areas associated, issues associated. We have focused, yes, we feel finance is one of the important, most important, I think so. It is a critical factor for promoting renewables, but that is one area where we have not much speakers. So today we have a very learned speaker who will, enlighten us about the financial management. So financial management, I was reading, is something which is very important, as it allows a business to not only plan, invest, and sustain. So these are three things which are required if we have to move towards our net zero goals. We have to, invest in renewables. We have to have finances for renewables, and we also have to sustain this business. So a sound financial analysis or a sound financial management helps better forecasting, better projections. So cost has been a big issue with renewables. As we have gone for more and more, propagation, more and more mass scale, deployment, our costs have come down, and it is and the R&D or the technology efforts which have been put, the efficiencies have also improved. So these are very positive factors which have promoted these clean energy sources, but we have bigger goals. The National Mission on Green Hydrogen, it envisages we have to go green, totally green. So I feel now finances is very critical, and we are very lucky to have with us today Mr. Rakesh Bhan. He is from the State Bank of India, retired on a very senior position, and he has all the knowledge and expertise or enlightening us on how we can finance, mainly if it, the renewables, or you can say most of it is in the decentralized sector. We have decentralized applications, small applications, which require small finance. But of course, finance is required. So I welcome you, Mr. Rakesh Bhan, to this seminar. And I think that today we will really know more and more how the guidelines which have evolved in terms of making renewables as a priority sector for lending by the banks is being now the enabling factor by the banks, how banks are really helping us to take this forward. So welcome once again to all the participants and to Mr. Rakesh Bhan. And I request Mr. P.V. Singh to kindly introduce the speaker.
Thank you, ma'am. Thank you very much for welcoming the speakers and all the participants. Good afternoon, everyone, and welcome to the 61st series of webinar Skill Council for Green Job is organizing a series of webinars to celebrate Azadi ka Amrit Mahotsav as a part of India's celebration of 75 years of Independence Day. In this series, SCGJ is inviting eminent and learned speakers in different sectors on sustainable development, renewable energy, and waste management, so as to deepen the understanding of recent developments in these sectors. The first in the series was launched on 24th September 2021. Today we have Mr. Rakesh Bhan, who is very experienced, learned, and distinguished speaker, who will be sharing his expertise and experience on financial management for micro, small, and medium entrepreneurs. Mr. Rakesh Bhan holds MSc Physics and MBA degree with more than 30 years of banking sector's experience. He earlier served with distinction in the State Bank of India as a AGM and technical officer within its Chandigarh-based consultancy cell, during which he conducted a vast number of techno-economic viability studies for the small, medium, and large enterprises. Mr. Bhan has been quite forthcoming on the capacity building front versus organizations on numerous programs on industrial management and entrepreneurship development. He has also actively participated in large number of skill development programs organized by the Staff College of SBI. Mr. Bhan is also well familiar with the issues and prospects of a diverse range of the industries related to drugs, plastic, leather, and food processing, more so solar photovoltaics. It was this crystal clear understanding which stimulated him to install a net metered 8 kilowatt peak solar rooftop system at his residence. He is currently engaged as an independent management and financial consultant, especially for the critical MSME sector of our country. Now I would like to request Mr. Rakesh Bhan to start your presentation. Over to you, sir. Thank you.
Thank you, Mr. Singh. At the outset, good afternoon to all of you. At the outset, I would like to extend my hearty gratitude to the office bearers of SCGJ for giving me an opportunity to present the financial management aspects of micro and small entrepreneurs. You know, micro, small, and medium entrepreneurs form the backbone of Indian economy, and Indian economy is having a substantial share in GDP. MSMEs is having a substantial share in GDP and exports also. I have observed in my career in bank, micro and small entrepreneurs are only one-man show. They don't afford to keep CAs and financial managers for running their units. So they have to do themselves. And finance is the aspect they must understand. That is how I have designed a small presentation for financial management aspects of micro, small, and medium enterprises. Let me begin the presentation. I'm sharing the document. Once again, I welcome all of you to the financial management for micro, small, and medium enterprises. The opening thought of my presentation is that finance is a business. Finance to a business is just like bullet to the body. All of you are aware of the fact that what will happen to the body without blood? the body is going to perish without blood. In the same way, finance is the lifeblood of any organization, business organization. So we have to tell about the how finance will be applicable for this business organization. Firstly, I will be sharing with you about the financial statements. I will be sharing with you what are the financial statements, basic component of finance. All of you are aware of the fact that trading, manufacturing account, trading in case of trading unit, manufacturing unit, or for a manufacturing unit or a service unit, and profit and loss account. These are the accounts which are required for showing the profit and loss or organization. In the same way, there is a statement which shows what the company owes and what the company owns. That is known as balance sheet. Balance sheet has got two aspects. One is two sides of balance sheet. Those are balanced. One is the liability side, another is the asset side. The liability side of the total is equal to the asset side's total. We will discuss it in detail in my subsequent slides. The components of audited financial statement. I have told you about the financial statements. Financial statements are profit and loss account, trading account, and balance sheet. But what are the components of audited financial statements? There are 7 components of audited financial statement. As all of you are aware of the fact that a financial statement has to be audited by a certified chartered accountant before presenting it to the public or before presenting it to the bank. This forms the Bhagavad Gita of any organization. Firstly, the proprietor or the partner or the director's report is there in the audited financial statement. If it is a proprietorship firm, proprietor's report will be there. If it is a partnership firm, partner's report will be there. Managing partner's report there. And if it is a private limited company or a public limited company, there will be director's report in the financial statement. This is the first component of audited financial statement. Next comes auditor's report. Auditor's report tells us about the audit, how the process of audit has been carried out by certified qualified chartered accountant, and he is giving the report for that. Next, we have profit and loss account. Profit and loss account tells us what has happened to the unit over a period of time. It tells us about the profitability or the loss of the unit. We will discuss it in detail in my next slides. Next comes balance sheet. Balance sheet, as I have already told you, that it is a statement of assets and liabilities where total assets is equal to total liabilities. It shows how much the enterprise owns and how much it owes. Normally, these figures should be equal. So all the balance sheet total of liability side should be equal to total of asset side. We will be discussing this in detail in my subsequent slides. Then there are schedules. These are schedules to the accounts of the account, schedules in the balance sheet. Then there is notes to accounts. The accounts, this is the 6th part of the balance sheet, and then cash flow statement. Cash flow statement tells us where from cash has come, whether it has come from operations or whether it has come from non-operations, and where the cash has gone. This is also a part of audited financial statement. Let us first see about the financial statements. Financial statement tells us information about unit's financial performance. What are the accounts which tell us about the financial performance? Financial performance is for a period of time, say 1 month, 6 months, 12 months, depending upon the financial period chosen by the enterprise. Unit's financial performance contains information about the total profits, contains information about the gross profits, net profits, gross sales, net sales, and all other that. In the subsequent slides, I will tell you about profit and loss account, which shows us about the financial performance of a unit over a period of time. Next comes the financial position. The financial position is as on a particular date. This is being shown by the balance sheet. What the company owns and what the company owes. The balance sheet tells us about that. What the company owes and what the company owns. Now, I have told you that there are three main statements: trading account, profit and loss account. This can be clubbed into one. It is for a period of time, and then there is a balance sheet. What are the components? What are the items under the profit and loss account? This slide tells us about the components about the first is gross sales. The gross sales of a company tells us that how much gross sales have been done by the company over a period of time. And when we reduce it from GST or excise, it was in the previously it was excise, now it is GST, we get net sales. So profit and loss account tells us about gross sales and net sales. In certain organizations, they also do trading also, and there we have sale of raw material. Normally, raw materials are to be purchased by the unit, and there is sale of the raw material. It can be shown in the profit and loss account. Similarly, purchase of finished goods, FG purchase in a trading organization is being shown under profit and loss account. Next comes raw materials and consumables. What are raw materials? In any manufacturing organization, raw material is just like kacha mal. It is being converted into semi-finished products, and then it's being converted into finished products. And what are the consumables? Consumables are those expenses incurred by the company which does not go directly to the finished products. It is consumed in the process. Like if there is any forging unit, in forging unit, consumable may be oil for the furnace. Steel is heated in a forging unit, and what that steel gets hot, and the oil which is consumed by the furnace is a consumable. Next item, main item under the profit and loss account is depreciation. Now, question arises, what is this depreciation? Depreciation is nothing but an allowance for wear and tear and obsolescence of a machinery over a period of time. Depreciation is a non-cash expense. It tells us about how the assets has been diminished value. There are two types of depreciations. One is from income tax point of view, another is from company's point of view. We charge depreciation in profit and loss account to the assets. The assets can be land. On land, there is no depreciation being charged, and depreciation is being charged on building and civil works at some percentage as per income tax rules. Then there is plant and machinery. Plant and machinery, let us take the example of a solar power, ground mounted solar power plant. In ground mounted solar power plant, plant and machinery will be your solar panels, inverter, and we charge depreciation on that for every year. So this is I have made you understand that depreciation is a non-cash expense. It is only an allowance for wear and tear and obsolescence of machinery, which we do it. That is why we add back depreciation back to net profits when we do break-even point, when we do debt service coverage ratio analysis. I will tell you that in detail in my subsequent slides. Next comes interest. There are two types of interests in any business organization. One is working capital loan interest and another is term loan interest. What is working capital loan? Working capital loan is for the loan for the day-to-day requirements, like for purchase of raw materials, conversion of raw materials into semi-finished products, conversion of semi-finished products into finished products, and also expenses incurred on consumables. And this interest on working capital is charged to the profit and loss account. And second is interest on term loan. Supposing we purchase a machine for an industrial enterprise like solar panel inverter for an ground mounted solar power project, the interest on the term loan will be charged to the profit and loss account, because term loan is being given to finance the fixed assets of the project. In the same way, there is non-operating expense, non-operating income and expenditure. Till this point of time, I have told you about the operations of the unit, but there can be non-operating income also in the unit. What is this non-operating income? Non-operating income is nothing but the income which does not come from operations, it comes from other sources. Like if there is a company, it has invested in shares, the dividend coming out from shares is an income to the company, and that is a non-operating income to the company. Similarly, there is property of the company which has given on the rent to others. That rent coming is an interest, or rent giving by the company is an expenditure. So this also falls under the category of profit and loss account. Appropriation of the profit, most important thing, that a profit and loss account tells us about net profit. But now this net profit is there, how this has been appropriated. This appropriation of net profit is by way of giving dividends to the shareholders, or by way of drawals by the partners or proprietor of the unit, or by way of plowing back the profits into the unit. So this is how we appropriate the profits. Then there is cost of production. All production costs less by net sales gives us cost of production. And then there is lastly cost of sales. When we reduce selling expenses from cost of production, we get cost of sales. So I think I'm clear on trading account, I'm clear on manufacturing account, and I'm clear on profit and loss account. Still, if there are any questions at the end of this presentation, I am available for the questions. Now comes balance sheet. Now, I have already told you in my first slide that balance sheet is a statement that tells us what the company, what the business owes and what the business owns. This company, there are two sides of balance sheets. As you have already seen, if you are a business person, you might have prepared the balance sheet. There is liability side and there is asset side. What are the main items under liability side? You can see this slide. The capital, equity or preference shares. This is the first thing in the liability side. How much capital has been invested by the promoter of an enterprise, whether it is micro scale, whether it is small scale, or it is medium scale. Capital is always there. It is the stake of the proprietor, promoter, or director in the business. Then comes equity. Equity is sort of another name of capital. It is a capital and equity are synonymous to each other. And then preference shares. If it is a company, then the company might have shares, equity shares and preference shares. Preference shares, the difference between equity shares and preference shares is that in preference shares, the dividend is given at specified rate, whether the company is getting profit or not, but as these shares are given preference, dividend is being given to them. Next comes share application money. Share application money is in case of existing enterprise and a company. The applicants who intend to become shareholders of the company or the organization or the enterprise, they have to put share application in this way. It forms a part of capital or equity of the enterprise. Next comes the deposits from dealers. Deposits from dealers, the dealers are there. Dealers are there. If there is a manufacturing unit, he has got that manufacturing unit has got dealers. What dealers are giving security to the manufacturing unit, that deposit with the company is a liability for the company, and it is shown in the liability side of the company. Next comes most important thing is secured loans. What are the secured loans? Secured loans are the loans from the banking channel. These can be in two types, two sorts of secured loans. One is working capital loan, another is term loan. These are secured loans by any banking organization, maybe State Bank of India, where from I am. These secured loans are working capital loan or term loan. Then comes unsecured loans from friends and relatives. F&R means friends and relatives. Unsecured loans, these are not secured loans, unlike banking loans. So these all form the part of liabilities. And then comes tangible net worth. What is this tangible net worth? Tangible net worth is nothing but capital plus reserves minus intangible assets. I will make you understand the definition of intangible assets once we go to asset side of the balance sheets. Tangible net worth is a part of liabilities. It is capital plus reserve minus intangible assets. Next comes deferred tax liability. Deferred tax liability is a liability which is in the form of deferred payment of tax, that you are deferring the tax. Somebody is telling me to talk in Hindi also. I will try to talk in Hindi also, and I will try to make mix language also. Deferred tax liability एक ऐसी liability है जो कि टैक्स की deferment की liability होती है. Next comes revaluation reserve. Revaluation, you know that if the book value of any asset is today 100 rupees, but market value can be 200 rupees. 200 रुपया उसका market value हो सकता है. The difference between book value and market value is kept in liability side as revaluation reserve. This is the last part of the liabilities. Next, I will come to asset side. Main items under asset side. First and foremost item are inventories. पहली inventory है. What are types of the inventories? There are three types of inventories in any business organization. The first inventory is raw material and consumable. First type of inventory, raw material and consumable. Second type of inventory is stock in process. Once there is half process and there will be some semi-finished goods, this is a form of stock inventory. And then there is finished product. It also forms a sort of inventory. These are the assets. These are the items under assets. Then comes receivables. The receivables are the money given, जो उधार हम देते हैं, sundry debtors होते हैं, उनको हम पैसा, उनको हम goods उधार देते हैं, and that form is in favor of receivables. And then comes fixed assets. These are the inventories and receivables are nothing but these are the current assets. Current assets are those assets which can be converted into cash during the operating cycle or 12 months, whichever is lower. Whereas fixed assets are those assets which are fixed in nature. I will give you the example of fixed assets. सबसे पहले मैं आपको ये बताना चाहूंगा कौन कौन तरीके का fixed assets है. Let us take the example of a ground mounted solar power project. In ground mounted solar power project, the fixed asset is land and civil works. Land is there, then building is there, then plant and machinery is there, then miscellaneous fixed assets are there. These all form the fixed assets, and these are all the parts of assets of an assets of the balance sheet. Next comes investments. Investments in associate concern and investment in other shares also. Then comes loans and advances. The loans and advances are shown as an asset in the balance sheet. There can be loans and advances to the directors or to the promoters or to the partners of the company. And there can be loans and advances to the employees of the companies. These form the assets of the company. तो ये दिस विल कम अंडर एसेट शीट्स. जैसे मैंने आपको पहले बोला दो साइड्स है बैलेंस शीट के, लायबिलिटी साइड और एसेट साइड. लायबिलिटी साइड हमने पिछली स्लाइड में डिस्कस किया, एसेट साइड में इस साइड में डिस्कस किया. एंड द मोस्ट इंपॉर्टेंट लास्टली व्हिच कम्स इन द एसेट्स इज intangible assets. Intangible assets क्या चीज है? Intangible assets are those assets which cannot be felt or which cannot be touched, which are intangible in nature, like patent, goodwill, patent, software, investment in software. These cannot be touched, but these are also there. They have a book value, and it has to be shown in the assets. I think I'm clear on the financial statements, balance sheet, profit and loss account, and trading account. Next comes financial analysis. How we do financial analysis of a business organization. There are three tools are there here which we do. First is ratio analysis, second is break-even point analysis, third is cash flow analysis. I will tell you one by one about these types of analysis. In ratio analysis, we prepare some ratios like net profit margin ratio is there. It will be net profit divided by sales, net profit divided by net sales. So it tells us that this analysis of ratio tells us how the ratio has increased or decreased over a period of time. Like in first year, if it has 5% margin, second year it can have 6% margin, third year it can have 7% margin. This margin, this is similarly we have another ratio which is used to judge the liquidity of the unit. That is known as current ratio. Current ratio is nothing but current assets divided by current liabilities. It should be it should be nearly 1.33 as per bank's norms. Then there can be gearing ratio also. Gearing ratios are those ratios which tells us about how much is the equity and how much is the debt component of any business organization. Supposing we have a 30-70 gearing ratio, 30% is equity, 70% is debt. So we can calculate it, and then we can see how this ratio has changed over a period of time, or how we are assessing the ratio in terms of industry also. We can compare it with industry level also. Next comes break-even point analysis. What is break-even point? Break-even point is most important thing and most important analysis, which I will be telling you in detail the break-even point analysis. In break-even point analysis, nothing but a point at which the company is having no profit or no loss. That means the company has a 0 point, zero loss. It is a zero loss and profit company point of a company. We see the break-even point as a percentage of capacity. If the break-even point is less than 50% of the capacity of the unit, we say the unit is viable. We will discuss this in detail in my subsequent slides. Then there is cash flow analysis. Cash flow analysis, I have already told you in the first slide, and in the audited financial statements, it is the analysis done how the cash has come and how the cash has gone, whether the cash is coming from operations, whether the cash is coming from sale of plant and machinery, whether the cash is coming from the sale of building. It shows the components of cash coming into the business and components of cash going out of the business. So that is cash flow analysis. Importance of ratio analysis, I can tell you in 2 lines. Ratios are as accurate as the reclassification done as per CMA data format. What is CMA data format? This point I want to make it clear. CMA means credit, M means monitoring, A means arrangement. Credit monitoring arrangement data. This data is being compiled by every bank before analysis of the ratios or doing any financial analysis of any business enterprise, whether it is a micro enterprise, small enterprise, or a large medium enterprise. These ratios are converted into these ratios are calculated from the CMA data itself. So the ratios are accurate as we reclassify the financial data into CMA data. Then ratios reveals a lot about the financial health of a unit on a particular balance sheet date or between 2 balance sheet dates. Supposing in the last year, I have a net profit ratio margin of 5%. In this year, it has increased to 7%. Then I can say with authority that my business has improved by comparing the ratio of the last year with that of present year. That is the significance of ratio analysis. Let me come to the next slide. No single ratio is being seen in isolation and conclusion drawn on its basis. Yes, we cannot see it in isolation. On a single basis, it has to be, all the ratios should be studied in tandem to form an impression to the overall financial health of the unit. So what is the overall financial health of the unit? We select all the ratios and we find what is the significance of these ratios. We try to compare the ratios of the unit, ratios of the enterprise with the ratios of the industry level and see where our unit is working. Ratios are just like several tools in the credit appraisal decision. There are several tools in the credit appraisal decisions, which I will tell you in my next slide. Now comes financial viability. Let me make you clear about the difference between financial profitability and financial viability. These are 2 things which are being told these are synonymous, but these are not synonymous. Profitability is the net profit of the unit. It is generated from the operations of the unit or from the non-operations of the unit. But when that profitability is used to repay the repayment obligation of the loans of the unit, we say then the unit is viable. If the profits are sufficient to repay the repayment obligation of the unit and plow back the remaining profits back into the unit, it is called financial viability of the unit. There are several tools for assessing the financial viability. Like if you will go with a project report to a bank will use these tools to see whether your project is financially viable or it is not financially viable. So Firstly, there is break-even point analysis. Already told to you, I will discuss this in details in next slide. Then there is debt service coverage ratio. That is known as DSCR, debt service coverage ratio. This also I will tell you in detail in my next slide. Then comes payback period. Payback period is the the period within which the investment is returned back. So it is also a tool for assessment of viability. Next comes net present value, NPV. This also I will discuss in detail. Next comes internal rate of return. This also I will tell you in detail. These are the several tools of assessment of viability of a unit to see whether it can repay its debt repayment obligation and generate profits for sustaining of the business. Then we have project risk analysis. Project risk analysis are two types of analysis. One is sensitivity analysis. Another is scenario analysis. This also I will discuss in detail in my next slides. In financial analysis, let us take the example of a ground-mounted solar power, which is a greenfield project, ground-mounted solar power project, a renewable energy project. What for do we require money? That is known as project cost. We require money for land and site development. Like if it is a ground-mounted solar power project, then the land on which the solar panels are installed on the mountings, that is known as it has some cost. Land has some cost. It is being funded in the project cost, and then there can be some levelings of the land. Site has to be developed, and their cost will be incurred on that also. So this is land and site development cost. Another is building and civil works. You know, in a ground-mounted solar power project, the buildings are used for housing inverters only, while as civil works are used for doing the civil works for the mountings of the panels which are on the ground. So the cost incurred on the building and the civil incurred is to be funded in the project cost, and it is a part of project cost. Next comes plant and machinery. What are the components of plant and machinery in a ground-mounted solar power plant? You can just appreciate that these are solar panels, these are cables, these are fasteners, this is AC/DC box, DC/DC box, then there is inverter. These form the part of plant and machinery. This has some substantial cost, and it is being funded into the project cost. Next comes miscellaneous fixed assets. Miscellaneous fixed assets are those assets which are miscellaneous in nature, like furniture and fixture, ACs, like security card, generator, and like other things, furniture, fixture, computers and telephones. These are all miscellaneous fixed assets. It is also incurring cost. Now comes expense on foreign technicians. This is expense on foreign technicians. If you are using an imported plant and machinery in ground-mounted solar power project, the foreign technicians will come to install the plant in India. Then the expenses incurred on foreign technicians is also funded in the project cost. These expenses, there can be lodging expenses of the technicians, boarding expenses of the technicians, their daily allowances, their salaries. This is all funded in the project cost. Similarly, there is training expense of Indians abroad. If Indian people are going, Indian manpower is going abroad for training purpose, those expenses are funded in the project cost, and this forms the cost of the project. Then comes preliminary and capital issue expense. What is preliminary expense? Preliminary expense is an expense which is charged to the unit, preliminary, which is preliminary in nature. Like if there is a company, you have formed a company, ABC Limited, ABC Private Limited, then ABC Private Limited will have preliminary expenses for company formation. There will be fees also, fees to chartered accountant, fees to consultant who will float the company. Then there will be, if it is a public limited company, there will be capital issue expenses also. This will be also there. Then there are provision for contingencies. No, sorry, before that is pre-operative expense. Pre-operative expenses are those expenses which are incurred in the which are incurred by the company before the operations of the unit, like interest during implementation period. All of you are aware of the fact that ground mounted solar power project gets implemented into 6 or 8 months, and what will be the interest on term loan during this gestation, during this implementation period of 6 to 8 months will be funded in the pre-operative expenses, or the salaries to the company managers will be funded into pre-operative expenses during the implementation project. Next comes contingencies. Contingencies are the provision for contingencies are for firm cost and unfirm cost. On firm cost, there are no contingencies, but on unfirm cost, like you have got quotations and you don't know cost may increase tomorrow due to escalation, rate escalation, that for that you have to provide for contingencies. So those contingencies are there. This can be between 2.5 to 5% of the value of the asset. Next comes margin money for working capital. Margin money for working capital is also being funded in the project cost, because this is the margin of the entrepreneur on the working capital loan. So this has to be also funded in the project cost. I think I'm clear on the financial analysis of project cost. I have told you what are the components of the project cost on which these financial analysis being done. Next comes the means of finance. This project cost and means of finance should tally, because if I have to incur money, it has to come from some source. There are 3 types of sources from where money can come into an enterprise, whether it is micro, small, or medium. First is capital or equity. Capital is nothing but the stake, the share of the person who is putting into the capital. Next is interest, internal accruals. Internal accrual is for the existing unit. When profits are being generated, these are being flowed back into business. This comes in the form of internal accruals. And then in financial institution contribution is term loan from bank, deferred payment guarantee, and these term loans for the bank is used for financing the term asset, like fixed asset, building, plant and machinery, miscellaneous fixed assets. This is the term loan from the bank. Deferred payment guarantee is that if you get a machine on hire purchase, and that bank gives a guarantee that you are going to repay the amount to the hire purchaser as and when it is due. So that is deferred payment guarantee. And lastly, there is subsidy from government. Normally, once when I do project appraisal of units, I never take a subsidy as means of finance. Subsidy is a sort of cushion, and our project should be viable without subsidy. And whenever subsidy will come, it will go into reducing the repayment liability of the unit by repayment of term loans. So these are the means of finance. Means of finance and project cost, these should be equal. Now let me jump up to next slide. Next slide is financial viability. There are 2 types of decisions which we can make in doing financial viability analysis. One is non-discounting criteria. Another is discounting criteria. In non-discounting criteria, we have break-even point, debt service coverage ratio, payback period, PBPBP. In discounting criteria, we have net present value, NPV, IRR, internal rate of return, and discounted payback period. We will discuss these in detail in my next slides. First, profitability assessment. Profitability assessment is done for a period for which the loan is to be repaid. If the loan is repaid in 4 years, profitability assessment will be done on these 4 years as shown in the slide, year 1, year 2, year 3, year 4. And there will be projected sales, there will be raw materials, you will be projecting it for year 1, year 2, year 3, year 4. Consumables will be there, other manufacturing costs will be there, depreciation will be there. Depreciation, I have already told you that it is an allowance for wear and tear or obsolescence of machinery. It is to be charged every year as per Companies Act or as per income tax, as the case may be. Then interest, there are two types of interest, as I have already told you, working capital interest and term loan interest. Working capital interest and term loan interest are to be charged in the profit and loss account in year from year on to year. Then there can be other fixed account, and lastly there is net profit. This financial assessment is being done for the period of term loan in any organization, whether it is micro, small, and medium enterprise. Tools for financial viability, DSCR, as I have already told you in the beginning. Understanding viability, it is ability to generate surplus so as to service repayment obligation and generate profit to flow back into the business. Let me translate it into Hindi, as somebody was telling me to share something in Hindi also. Ability to generate surplus, मतलब एक उद्योग के अंदर में जो उसके अंदर सरप्लस जनरेट होगा बाय वे ऑफ प्रॉफिट्स, उससे हम रिपे करेंगे डेट ऑब्लिगेशंस को, रिपेमेंट ऑब्लिगेशंस को, लोन को, और फिर उसके अलावा प्रॉफिट जनरेट करेंगे बिजनेस में डालने के लिए. दिस इज एबिलिटी टू जनरेट surplus so as to service repayment obligation and generate profits for flow back into the business. DSCR is the tool. What is this DSCR? This DSCR can be gross DSCR and net DSCR. In gross DSCR, we have a formula, empirical formula for that. Net profit plus depreciation plus interest on term loan divided by interest on term loan plus repayment of term loan. What does this signify? Numerator में हमारा net profit, but depreciation is a non-cash expense. That is why we are adding back it to the net profit, and we are adding back to the interest on term loan. In तीनों में से we have to repay the loan installment, repayment of term loan, and repay the interest on the term loan. It should be normally in the ratio of 2:1. 1 point gross debt service coverage ratio जो हम करते हैं, एवरेज जो हम निकालते हैं हर साल में का एवरेज करते हैं, it should be between 1.6 and 1.8. Next comes debt service coverage ratio net. In net debt service coverage ratio is net profit plus depreciation. Here you can see there is no interest on term loan, and in numerator there is no interest on term loan, and denominator there is no interest on term loan. So net profit plus depreciation divided by repayment of term loan. Financial viability, gross debt average debt service coverage ratio should be between 1.6 and 1.8. And if it is more than 2, it is acceptable for the project. We say that the project is viable. What does this mean? Net profit and depreciation plus interest on term loan is twice the repayment of term loan and interest on term loan, round about twice, or 1.6 or 1.8 times. So this is all about debt service coverage ratio. I think I am clear about the debt service coverage ratio. Now I will tell you about break-even point analysis. But before doing break-even point analysis, we must understand costs. एक cost का क्या चीज होती है? There are various types of costs in any organization, in any business enterprise. First is fixed cost, जो fixed in nature है. These are also known as step cost. These जो capacity का cost है, fixed cost है. Then there is variable cost. It varies with the production. Then there is semi-variable cost. Semi-variable cost is that cost which is a portion of where some portion is variable and some portion fixed, like the cost of electricity. There is meter rent. There is meter rent that is fixed, and there are some fixed expenses. Then there is per unit cost. So these are known as semi-variable costs. Then direct costs. Direct costs are those costs which are directly allocable to the project, and then indirect costs which are indirectly allocated to the product. And then opportunity cost. In opportunity cost, there are two courses of actions. Two courses of actions are in opportunity cost. Number one, if you have money of 1,000 rupees, there is a chance for you can spend it in share market, or you can get it a fixed deposit from the bank. If you go into the share market and invest money in share market, the opportunity cost is that you will lose the interest which by not investing into the bank. That is known as opportunity cost. Now let us understand break-even point analysis. This is a graph between number of units and sales and costs. You can see the x-axis, there is number of units, and you can see the y-axis, sales and cost. There is fixed cost line which is parallel to x-axis. This line is parallel to x-axis. This is known as fixed cost line. This is variable cost. This line, light violet line, is a variable cost. It varies. Once there is zero production, zero cost. One, cost will be this much. Two, n, cost will be this much. Total cost will be, we are superimposing these total cost and variable cost and fixed cost, we are superimposing. And then there is sales line on revenue line. Now, as I have already told you that break-even point analysis is a point of no loss, no profit. Where the sales line and cost line will intersect, it is known as break-even point analysis. You can understand this break-even point by this formula. Break-even point is fixed cost divided by sales minus variable cost per unit, and break-even point in amount is fixed cost into sales divided by sales minus variable cost. This is the final. If we have to derive break-even point, this formula is to be derived. We say let V be the variable cost per unit, S be the selling price per unit, F be the total fixed cost, BE be the number of units at the break-even point. Then we have the empirical formula, sales is equal to cost plus profit. But at break-even point, profit is zero. So sales will be equal to fixed cost plus variable cost. Fixed cost, sales will be BE into S. BE is the number of products at break-even point, S is the selling price. And this will be equal to BE into V plus F. BE into V plus F. In that case, we will find F is equal to BE is equal to F divided by S minus V. And in value, we multiply it by selling price. This is the derivation of empirical formula for break-even point analysis. This, I am repeating this graph. This graph has two zones. One is loss zone, another is profit zone. Our break-even point in an organization should be as low as possible. If it is around about 40, 30, 40 or less than 50% of the capacity of a plant, then we say the project is viable from the break-even point of view. This is profit zone, this is loss zone. In this area, revenues are less than the costs. That is why this is loss zone. Here revenues are more than the cost. That is how it is known as profit zone. Financial viability. Then we have, I have told you financial viability about non-discounting criteria. This is the last point on break-even payback period. This is the length of time required to recover the initial investment. That is payback period. Supposing you have initial cash outflow of 100 rupees. You recover it by 30 rupees as cash inflow in first year, 40 rupees in second year, and 30 rupees in third year. This means that 3 years is the payback period. The shorter the period, more acceptable the project is. Next comes the most important thing of project viability analysis, which we are doing through discounting criteria. There are 3 tools on doing the project viability analysis on discounting criteria. First is net present value, NPV, net present value. In Excel sheet, you can find it by at the rate of NPV. Give the range, you will find the NPV. But I will make you understand in the next slide what is NPV. Next comes internal rate of return, IRR, internal rate of return. And next is discounted payback period. What is the payback period? But that in the first case we had non-discounted. Here it will be discounted. I will tell you the difference between these 3 one by one in my next slides. Net present value. Net present value is cash outflow minus present value of cash inflows in subsequent years, discounted at some rate which is near to inflation. What does this mean? This means the present value of future cash inflows. You find it by discounting it at a nearly inflation rate. And then you subtract it from the initial cash outflow, that is net present value. Net present value, if it is positive, you accept the project. If net present value is negative, you reject the project. This is the empirical formula. This is the empirical rule for net present value, that if you will have to accept the project if NPV is positive, reject the project if NPV is negative. NPV, I have made you clear. NPV is cash outflow minus present value of cash inflows in subsequent years, discounted at some rate which is near to inflation rate. Next comes internal rate of return. Internal rate of return, IRR, is that rate of discount at which initial cash outflow is equal to the total present value of cash inflows in the subsequent years. What does this mean? मेरा cash outflow अगर 100 है and cash inflow different years में 50, 20, 30, 40, इनको हम discount करेंगे to find their present values. और जो इनका, if that cash outflow is equal to present value of cash inflows, at that time NPV is 0 and that discount rate is known as IRR. So this means that at discount rate of IRR NPV is 0. Simple fundamental. जब NPV मेरा 0 होगा, जो मैं discount rate ले लूंगा, that will be internal rate of return. Except the project if IRR is higher than the bank offering rate of interest on deposits. अगर मेरे पास 1000 रुपया इन्वेस्ट करने के लिए बिजनेस में है, मैं वो फिक्स डिपॉजिट में भी लगा सकता हूँ, बिजनेस में भी लगा सकता हूँ. जब मैं फिक्स डिपॉजिट में वो लगाऊंगा तो मेरे को फिक्स्ड रेट ऑफ डिपॉजिट मिलेगा, लेकिन मैं बिजनेस में तभी लगाऊंगा जब मेरे को रिटर्न, इंटरनल रेट ऑफ रिटर्न फिक्स्ड डिपॉजिट रेट से ज्यादा होगी. सो इंटरनल रेट ऑफ रिटर्न, you accept the project when this rate is IRR is higher. So जितना IRR higher होगा उतना प्रोजेक्ट के लिए अच्छा होगा. Next, lastly, there comes discounted payback period. In discounted payback period is the time to recover initial cash outflow by way of total present value of cash inflows in subsequent years, discounted at some rate which is near to the inflation. क्या होता है इसमें? फर्क क्या है अनडिस्काउंटेड पेबैक पीरियड और डिस्काउंटेड पेबैक पीरियड में? पेबैक पीरियड में हम सिंपल डिस्काउंट कैश इनफ्लोज को डिस्काउंट नहीं करते हैं, तो उनका सम टोटल कितने सालों में हम रिकवर कर लेंगे पैसा वो आ जाएगा. इन डिस्काउंटेड पेबैक पीरियड में वी डिस्काउंट इट बाय at some rate which is near to inflation rate, and then we see in how many years the initial investment has come back. Lesser the period, accept the project. जितना कम payback period, discount payback period हो उतना project के लिए अच्छा है. Next, lastly comes project risk analysis. There is no absolute certainty in any venture, that you are aware of the fact. An environment and enterprise works in environment, and this environment gives threats and opportunities to the unit. There is no certainty in any venture. क्या होगा फ्यूचर में वो पता नहीं है. Uncertainty comes from cost structure. Cost structure change हो सकता है. It comes from revenues. Revenues बढ़ सकते हैं, घट सकते हैं. Capacity utilization घट सकती है, बढ़ सकती है. Project life. And risk increases with time, technological complexity, and price sensitiveness to inputs and outputs. This is project risk analysis. Similarly, in project risk analysis, we have two types of analysis. One is sensitivity analysis, another is scenario analysis. In sensitivity analysis, the criterion of merit is net profit to sales ratio, debt service coverage ratio, BEP, NPV, IRR, to the changes in an underlying variable holding other variables constant. क्या होता है? हमारे पास underlying variables है. Sales price decrease होता है किसी कारण से, डिमांड कम हो गई, सेल्स प्राइस डिक्रीज हो गया, तो हमने सेंसिटिविटी प्रोजेक्ट की निकालेंगी. जो अदर पैरामीटर्स है उनको कांस्टेंट रखा है. तो सेल्स प्राइस, इफ आई रिड्यूस सेल्स प्राइस बाय 5%, what will be the impact on net profit to sales ratio? What will be the impact on debt service coverage ratio? What will be the impact on break-even point? What will be the impact on net present value? What will be the impact of IRR? These are all the sensitivities we are doing in sensitivity analysis. Lastly, there comes not summary, this is last but one, scenario analysis. In scenario analysis, we make a scenario that selling price भी cost होगा, raw material price भी बढ़ेगा, capacity utilization भी घटेगी. एक scenario बनाते हैं और उसमें हम sensitivity देखते हैं. Sensitivity of criterion of merit to net profit to sales ratio, DSCR, BEP, NPV, IRR, to the changes in more than one underlying variable. So if these, in that case, it becomes scenario analysis. So I would like to sum up what I have told you. I have told you in firstly about financial statements, profit and loss account, trading account, manufacturing account, balance sheet are the financial statements. Then I have told you that audited financial statements are there. 7 types of financial statements are there, audited finance. And project cost, where from, what for we require money for project. Those project cost has been specified by giving an example of solar ground mounted power project. Then we have means of finance. Then we have profitability assessment, financial viability tools. There are 2 types of criteria in assessment of financial viability. Number 1 is non-discounting criteria, where there is payback period, debt service coverage ratio, break-even point. And then there is discounting criteria. It is not net present value, IRR, discounted payback period. And then we have done project sensitivity analysis and project scenario analysis. Thanks for your patient listening. Thank you very much. If there are any questions, you are most welcome.
Yeah, thank you very much. I think it was a very elaborate analysis and you covered each and every aspects, though some of them were slightly, difficult for me because I am not from that field. But anyway, there are 2 or 3 questions which I would like to take from the audience, from the participants.
Yes.
First is, I think, Mr. Ajit Samant. He is our general manager. He is here in the Skill Council. He has asked 2 questions. One is that why the NPA is increasing day by day? Okay. And
why?
The NPA, non-performing assets.
Okay.
Yeah, when you have a, yeah. So mainly for the RE projects, this has been the problem, In fact, initial days when we used to have, loans for the projects or the subsidies, the projects, because they were not very viable, the NPA used to keep increasing. Now also, that's what was his question, why the NPA is increasing day by day? So
there are 2 factors why which NPA can increase. One is internal factor, another is external factor. Okay. Internal factors are within the unit, like promoters, they are diverse, they diversify into another activities. There is diversion of funds. These are internal factors. External factors means that the environment changes. There are threats in the environment. In that case, the unit becomes NPA. The NPA non-performing assets are those assets which have deteriorated over a period of time and profits have not come.
So do you feel technology also has a role in this?
Yes, I will tell you, like today, the technology is solar power project is from the technology is fast changing. When the technology is changing, the old units which are on old technology, they become obsolescent. And once there is obsolescence, they won't generate the profitability. So technology is a vital role to play in NPAs because technology is fast changing.
So there's another question from him. I think he wants that our organization should be free from all, problems. He says bankers have a lot of parameters or checklists to catch the insolvency of a company. Then why companies are going for insolvency, although they have submitted their quarterly stock statement to the bank against OD limit? I hope, Ajit, this is not applicable to us.
This Insolvency Act has come in the recent years. That any banker or the unit itself can make this unit as an insolvent. But this Insolvency Act is very much telling us about that how unit cannot work. If unit is not able to work, they can go for even a sundry creditor, sundry debtor can sundry creditor of the unit can tell it can insolvency.
But he's telling that if a company is depositing the quarterly stocks and all, if the company
no, that has nothing to do with insolvency. Insolvency is something that a unit does not generate profit from the operations. When profit, it does not generate profit. It is unable to repay the debt repayment obligation. When it is unable to repay the debt obligation to the bank, it becomes NPA. And that is
sometimes companies, where they are not able to pay the debt,
they are not able to pay the debt installments.
Then they declare
because there can be external problems also. There can be internal problems also. External problems are the problems given by the environment. Like demand of a particular project decreases, as a result of which there are no sales of the companies. When there are no sales, the profits are not, company is not able to generate profits and the unit becomes NPA.
Okay. I think Mr. Ajit, that must have answered your query. Now there's another query from Mr. Gokul Prasad. he says that can the subsidies or incentives offered through government schemes for procuring machineries, can they be included in the profit loss account?
No, actually, let me share with you. Subsidy is a means of finance. Theoretically speaking, there are three types of means of finance in a unit, which I have told you: promoters funds, bankers funds, and government funds, subsidy. But normally subsidy does not come in time. It gets delayed. So this subsidy is used by the when we do financial analysis, financial appraisal, project appraisal of any project, we never take subsidy into cognizance. We say that subsidy is not coming. Subsidy when subsidy may or may not come, and if it comes, it goes to repayment of term loan itself. So that is why subsidy we don't take it as a means of finance. It is only a theoretical concept that subsidy we can take as means of finance. Otherwise, we should have the profit should be viable without subsidy. And if it is with subsidy, it will change. It will reduce the interest burden of the unit by putting that subsidy amount into the loan account, by crediting it into the loan account.
Yeah, we also in some of the schemes, the subsidy was more oriented toward helping the beneficiaries.
But normally we have observed that it does not come in time. There are project cash overrun, time overrun, cash overrun in by way of not getting subsidy.
But there are limitations with the government also, because they raise the demand, and when the demand comes, then it is processed.
Yes, ma'am.
It is a very cyclic process.
Yes, ma'am. Yes,
ma'am. Yeah. And he has asked that will it be against the company's ethics while raising funds in the capital market, that is share market, for IPO?
No. It is not against ethics. If it is a public limited company, they can raise the issue, primary issue. They can float the shares in the, they can call share application money, and they can, it is well within the ethics that a company can raise funds from the share market.
Yeah. There is another question from Mr. John Thomas. He is a big person in the wastewater field, a consultant. He's asking, how is the viability gap fund requirement decided? How do you decide this viability gap fund?
Viability gap fund was being given in solar projects very large number of years before. Viability
now
gap.
Also, I think in the biofuel
at that time, the technology cost, the plant and machinery cost was very high. So there was a gap between viability of the unit, as a result of which viability gap fund was given by Government of India for funding those projects, for making them more viable, investing money in that project.
So has it got something to do with the IRR rate? In the
IRR is that rate which IRR should be more than
ROI, return on investment.
Return on investment or IRR, it is one and the same thing. Okay. Return on investment is how much return we are getting on the investment.
Okay.
So internal rate of return is the tool for return on investment. It is that rate of return at which the net present value of the future cash flows and present cash flow is zero.
So I want to ask you one plain question. We have so many projects coming up on clean energy sources. Technologies are not so ripe, and the finances are limited. So how do you see India's, stake? Like we have the green mission where we have allocated 14,000 crores.
These finances have been kept under priority sector advance now. Okay. Now banks are at liberty to do finance, and it comes under priority sector also. Okay. Green energy financing, all banks have got their targets to invest in by way of loans to such, like there are loans for biodiesel. These are green energies which are coming, renewable energies which are coming. So banks are doing funding for that.
And what is the effort taken by the banks? Like you are also into skilling to educate their officers, to educate their staff. Because that is a big problem.
The first and
Understanding the
foremost
project.
is positive mindset of the entrepreneur and the positive mindset of the banker. You know, banker is a stakeholder in the business, and there has to be a positive mindset that the project is going to be viable. In-depth analysis is must. In-depth analysis of project, analysis of NPV, IRR is a must. But we say that it is always good for that.
I can see one hand, Dr. Vanita Prasad. Mr. Ram, can you give her the speaking rights? She has raised her hand for a
Yeah,
question.
she has the permission now, ma'am.
Dr. Vanita
Yeah,
Prasad.
thank you, sir. Thank you, ma'am.
Yeah.
Sir, since ma'am was talking about this green projects which are coming up, so whenever we are talking to any biogas sector people, there is a very much, I will say the bankers are not ready to invest into the biogas plants. So how do you think that these, because a lot of entrepreneurs who have, I think, land and waste material available, wanted to go ahead with this as well as industry also. But as you mentioned, there are subsidy linked, and when they make an RO, make according to the what they will get the subsidy, but they are not getting it. And then they get into a soup. So how do you suggest that as a consultant also, or as a technology provider in this sector, we can help these people to make a good business and a real impact, because biogas sector will have an impact on environment?
Firstly, let me tell you that Government of India is doing very much positive things for promotion of biogas. They have included it into the priority sector advance. Every bank has got its target for doing these biogas projects funding. Biogas project funding, the process in all banks is that there is techno-economic viability studies. In techno-economic viability studies, there where the external factors are seen, whether the raw material availability is there, whether the technology is latest, whether the unit is able to do everything. Then these are the these are the system for the biogas. Biogas, CBG biogas is being promoted by the banks, and I don't think banks are not funding these projects. There are special targets for them. From the top management to the lower management, banks are doing funding for that.
You feel that there is allocation for the energy projects?
There is allocation for that. Targets are being kept for doing green business funding.
So how are you creating awareness about this, that the banks have separate this thing? Because people come up, see technology, land, finance, these are the problems. I think Dr. Prasad will agree with me that these are the problems, when people want to, they have issued so many LOIs. How many projects have come up?
I have done several TV studies. A TV study, mostly 80-90% positive results came. 10 to 20% negative results came. Every viability of the project will change from one project to another project. Like I will tell you one thing, the main thing is man behind the show, who is the promoter. If the promoter is not well versed with the business, how will bank finance to the unit? Bank will not finance to the unit. So the man behind the show is the first and prior importance of any taking financial decision by the bank.
So the person who's setting up the plant, he should be well versed.
Entrepreneur.
We have to do 5,000 plants. 5,000. That scheme. And I don't know how many LOIs have been issued, so many with the LOIs, but we don't see any.
I think 120.
That is the basic step. LOI is the basic step.
Yeah.
LOI is the basic step for this getting this loan. That is the basic step. After that, they have to apply to the bank. They have to, then bank does TEV study. Bank does the raw material assessment, raw material technology assessment, then financial assessment. And after that, the loan is sanctioned by the competent committee. There is
Okay.
appraising team. One is the appraising team. Another is sanctioning team.
What
They
is the time period it takes?
time period is 15 days to 1 month is the time period mostly.
Is it? So how many, okay, if it is not very this thing, how many projects has SBI sanctioned during your this thing? Or were you
During my tenure, a lot of projects have been sanctioned by the bank. A lot of projects have been sanctioned.
see, solar is something, as she's saying, solar is something where which has caught on. But
Yeah,
still
yeah.
in biofuels, bioenergy, I don't think so.
There are problems in entrepreneurs also. Mostly people see that they are getting subsidy in that.
Mhm.
The man behind, as I have already told you, that the man behind the show is the main thing. It is the project. We have to finance the project man. Who is the man behind the show? That is the main criteria.
Yeah, it has to be as a business, no? It
Yeah,
cannot be
yeah,
a subsidiary
it has
And
to be.
mostly this was linked with the subsidy. Gobar gas plant also linked with the subsidy, though they have not functioned. And then nobody bothered. Kuch amount aa gaya, pehle ka construction ka aa gaya, and then subsidy aa gaya, and then they.
Ultimately, bank loses the money.
Yeah.
Ultimately, bank loses the money. NPAs are there. Then there is waiver of loans and all that. Provisions is being kept for NPAs and all that. Every bank has got its own policy.
Issues.
Yeah, I think so. Yes, let's hope that we get more projects.
Yes.
Yeah,
Certainly.
our consultants can move forward and we can have more and more projects on field. So I think so. We have had a very nice and very elaborative discussion also, and we could really extract from you what we want to know about how our finances can flow for the bioenergy area.
Thank you very much.
Thank you very much, and thanks to the participants. I'll request Mr. PB Singh for a formal vote of thanks. Yeah, thank you very much, and thank you for this opportunity.
Thank you for giving me an opportunity to be the part of Sickle jobs for Sickle Council for Green Jobs.
Yeah.
For making me a part of that. Thanks for
We will look forward to you for more consultations.
Yes, certainly. I am there.
Yes, ma'am. Mr. Bhan also wants to another speech on microfinance. So, after some time,
I would like you to pick up an illustration of one industry, like what she was asking, and you can compare it with one which is closed because of NPA and one which is functioning or which is successful. That illustration you have to share with us. If you
And
are,
that will be a very good idea for us as knowledge,
because we should
how
know,
we can help the entrepreneurs, and then maybe the consultants who are doing this thing.
I don't
and
mind.
we are
You
doing.
choose a date, any date you
Yes,
want, you are welcome.
Yeah.
And please compare and tell us. Today we have given us all the intricacies, how the entire financial management system works.
Yes.
But then how it is applied to an industry which is successful. That illustration, if we get it without subsidy.
Yeah. Okay, ma'am. Thanks, ma'am.
Thank you very much. I hope it's not too tough.
No. Okay. Thank you. Thank you very much, sir, for the excellent presentation. And you explain very well with the formula and other examples. So first of all, I received a message from our finance team. They are very happy with your presentation, and they provide special thanks to you.
Thank you very much, sir. My pleasure.
Yeah, sir. Thank you very much. And next time, sir, we talk to on phone, and we will decide your next presentation sometime last February or sometime.
Pick up a decentralized system. DRE systems are also there, which are functioning well in the field. Yeah.
We think we should take themes of micro, small, and medium enterprises.
Okay.
Like in my career also, I have worked with micro, small, and medium enterprises. There are some themes, like marketing is theme, inventory is theme.
Okay.
We can take lecture series on themes.
Okay.
So in next, I can give inputs on marketing management.
Okay.
Because marketing is there are 4 types of managing, the 4 types. The one is man behind the show, personal management, then inventory, then technology, then marketing, and then financial. Financial management is covered. So let us, in the next my talk, let us cover marketing management.
Okay.
It will be better.
Okay. Okay, sir. And I would like thanks all the participants for the joining the webinar, and thank you all of you, and wishing you very happy Lohri, Makar
Yeah.
Sankranti, Pongal to all of you. Thanks a lot. Thank you, sir. Thank you very much.
Thank you, thank you, thank you,
very much.
Thank you, sir. Thank you, ma'am.
Thank you
Thank
very
you,
much,
ma'am.
Dr. Prasad. Yeah.
thank you, ma'am.
Thank you, sir.
Thank you, PBG.